With the market currently climbing higher than an elevator in the Empire State Building, it seems like it's going to take a Christmas miracle to find any discounted dividend stocks. Having said that, you might as well just start calling me Santa. Because in this video, I'll be sharing 3 that look like exceptionally cheap buys as we finish out the rest of 2022. But before we get to those, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if you love dividend stocks and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. And also leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. Anyway, getting into the first stock, I think Tyson Foods, ticker symbol TSN, is looking like a pretty good buy right now. In case you're not familiar with Tyson, this is a company in the consumer staples sector that owns all these popular brands and makes what I think are hands down the world's best chicken nuggets. These ones right here, guys, these are their air fried chicken nuggets, and like I said, these are seriously hands down like the best things you'll ever have. Anyway, like many stocks on the market right now, Tyson is up a little bit in the 1 month period, up about 2.6%, but year to date they are still down quite a bit, down 23.3%, and they are underperforming the market by quite a bit. Also, like many other companies, Tyson's profit margins have been negatively impacted by inflation this year, which could explain some of the losses we're seeing. From their recent earnings call, Tyson reported a near 30% reduction in earnings and operating income compared to the same quarter last year, but overall still reported gains for the full year compared to last. In fact, Tyson CEO Donnie King said they delivered record numbers for the year in both sales and earnings. So despite what the share price has been doing, Tyson still seems to be firing on all cylinders, at least for the most part. There was a little snafu earlier this month involving the company's CFO, John Tyson, who I think had a little too much to drink one night. He ended up entering the wrong home and was found completely passed out in one of the beds, which, you know, it happens to the best of us guys. In the earnings call though, he couldn't have been more apologetic and definitely owned up to his mistake. So I think it's all water under the bridge at this point. So that aside, Tyson is looking strong, like they've been getting high on their own protein supply and it's still as cheap as they come. Taking a look at the valuation metric, Seeking Alpha gives them an overall grade of A-, and if we just take a look at this first one right here, the PE ratio, it's 10.2, which is considerably lower than the sector median by near 50% and is also about 11% lower than the company's 5-year average PE ratio. Furthermore, if we scroll down, taking a look at the price to book right here, we can see it's 1.16. It's almost trading right at its book value, and this price to book is 61.5% lower than the sector median and is also 33.5% lower than the 5-year average. So definitely cheap in terms of book value, and the price to cash flow is looking equally as good, 7.01, right there in the single digits, which is about 53% lower than the sector median and about 38.3% lower than the 5-year average. So really across the board, Tyson looks to be attractively valued, and the Wall Street analysts are anticipating some pretty nice upside from this stock. They give it a high price target of $105 per share, a low price target of $62 per share, which isn't too much lower than where the stock is currently sitting, which leaves us with an average price target of $81.83, representing a near 22% upside. Which, just a little sidebar guys, definitely take this with a grain of salt. The Wall Street analysts, it's really just an opinion, and it's most definitely not guaranteed to play out the way that they're anticipating. At any rate, moving on and getting into their dividend stats, there's a lot to love here. The forward dividend yield is pretty average, just under 3%, but I think the rest of the stats are looking really good. The payout ratio is super low, just above 21%, with a lot of room to contribute more to the dividend if they wanted to, and this leaves them with a really high 5-year growth rate, about 15.4%, with a nice dividend growth history of 10 consecutive years. And furthermore, taking a look at just how long they've been paying the dividend without taking growth into account, this is looking a lot more consistent with over 3 decades of straight dividend payments. And moving on to stock number 2 today, I think Medical Properties Trust, ticker symbol MPW, is looking just so cheap, guys. And in case you're not familiar with this company, it's a real estate investment trust that owns a portfolio of hospital facilities around the world. And across their $21 billion portfolio, they have 434 different properties in 10 different countries, making them the world's 2nd largest owner of hospitals in the world. Now, MPW has seen a much nicer gain in the last month than Tyson, where they're up about 22%, super substantial gain. Year to date, though, they're still seeing a pretty hefty loss of over 44%, which leaves them with a really low P to FFO, just above 7, which we'll talk about in just a moment. But first, one of the major things currently plaguing MPW is actually one of their biggest tenants, a company called Steward, who MPW has loaned millions of dollars to and has an immense equity stake in. The big concern for many investors is that Steward will end up defaulting on these loans to MPW, which would obviously put them out hundreds of millions of dollars. As of their recent earnings call, though, MPW feels pretty confident about the entire situation and actually had a lot to say on the matter. We won't get into all of that, but to sum it up in one statement from their their CEO, Edward Aldog, Stewart appears well able to continue paying Medical Properties Trust rent. Now back to MPW's valuation, this is looking incredible actually. Seeking Alpha gives them an overall valuation grade of an A, and they're currently trading below their book value. So they have a forward price to book of 0.87, which is about 41% lower than the sector median. And scrolling down, taking a look at the P to FFO right here, which is the real estate investment trust equivalent of the PE ratio. This is also looking nice and low, currently sitting at 7.06, which is almost 51% lower than the sector median. So MPW is currently trading a lot lower than their actual book value, number one. But number two, they're looking a lot more affordably valued than some of the other real estate investment trusts out there. Not to mention, I think the financials for this company are looking pretty strong, but one of the most important metrics for real estate investment trusts is the FFO, and MPW is definitely delivering in that department. We can see if we pull up this chart right here that they're seeing a pretty aggressive slope upward in the funds from operation, which is what they use to pay the dividend. And over on the balance sheet, looking at the book value per share right here, this is also seeing a nice trend upward. And you guys are really gonna like these dividend stats. Just starting with the yield, it could not be higher, 9.08%, which is made possible in some part just due to the substantial decline in share price. But with this high yield, on the other hand, there's not much to speak of in the growth department, just under 4%, which I guess isn't terrible. And then they have a dividend growth history of 9 consecutive years, so there is some history of growing the dividend there, which is great to see. Overall, guys, it seems to me that there is a lot more good than bad coming from MPW, and the Wall Street analysts seem to agree with this sentiment as they have a high price target of $20 per share. They have a low price target of $10 per share, which isn't too much lower than where the stock is currently sitting. And then they have an average price target of $16.69, representing a near 31% upside. Now, stock number 3 is looking shipshape in prime for purchase. This is FedEx, ticker symbol FDX, which is the world's largest shipping company who currently delivers to over 220 different countries, connecting markets that comprise more than 99% of the world's GDP. Like the last two stocks, FedEx is seeing a nice gain in the last month where they're up nearly 13%. And also like the last two stocks, they are down year to date, down 31.66%, which also means they are underperforming the entire market. And FedEx was a pretty big beneficiary of the pandemic these last couple of years with huge jumps in revenue pretty much every quarter between 2020 and 2021. And with a lot of that now behind us, their sales are starting to revert back to the mean, which is why we saw this pretty substantial drop in share price back in September that they haven't quite recovered from. However, right now we are knee deep in the holiday season, and you guys know what that means. FedEx will benefit from all of the holiday shopping going on, and this time of year they actually upped their prices with surcharges, resulting in a huge boost in revenue this holiday season. Now, does this mean that a huge boost in share price is right around the corner? I don't know, guys, but I do know that right now the valuation is looking prime for purchase. Right now they have a forward PE ratio of 12.23, which is nearly 30% lower than the sector median and is 9.5% lower than the company's 5-year average. And if we scroll down looking at the price to book, they're almost trading at their book value. 1.78 for the price to book, which is 33% lower than the sector median and also 30% lower than the 5-year average. Now, looking at the last valuation metric, the price to cash flow, this is looking great, guys. 6.08, which is over 50% lower than the sector median and is almost 23.5% lower than the 5-year average, with some upside potentially to come according to the Wall Street analysts. They give FedEx a high price target of $295 per share, which is about $120 more than where it's currently sitting. They give it a low price target of $125 per share, about $50 lower than where it's currently sitting, and an average price target of $195.70, which represents a near 11% upside on average from FedEx. Now, the dividend stats here are going to look pretty similar to what we saw with Tyson. They have a pretty average forward dividend yield, 2.6%, with a very low payout ratio. This one's actually lower than Tyson's, under 20%, which is great. And with that, they have a nice 5-year growth rate of over 16%, but the dividend growth history is lacking. Only 1 year of dividend growth, but they've been making consecutive dividend payments for the last 19 years, so there is some consistency there, even though the growth isn't always there to be found. And now moving on, guys, those are not the only 3 stocks that I think you need to have your eye on as we move into December. There's still some more discounts out there, starting with Verizon here, who's down 25.6% year to date. And actually, my friend Dividendology, who has a great channel here on YouTube, just did a video talking about Verizon. I highly recommend you guys check that out. I'll include the link to it in the description. Next up is Scott's Miracle-Gro, who is down 66.25% for the year, guys. That's insane. Although they have seen a little bit of a rebound in the last month where they're up 13.25%. And this next one, Stanley Black & Decker, just really can't catch a break, guys. They're down 55.3% year to date. And in the last month, you know, like many stocks, they have seen a little bit of a rebound where they're up 7%. Next, I think you should keep your eye on IIPR, which is another real estate investment trust, and they're down 52.25% for the year, so big discount there. Another one is Nvidia. Definitely keep your eye on this one because they're down 46% year to date. But with that, as I'm looking at this, guys, I do see one red flag. Look at that PE ratio. It's 50.5. That's extremely high, so I would definitely take a closer look at that. All right, this next one to keep your eye on is Skyworks Solutions, which I actually talked about in last month's video, and they're down 42% year to to date, and the PE ratio is looking really low in the single digits, 9.63. And then we have Whirlpool here, who is down 36% year to date with a very low PE ratio, 7.74, along with T. Rowe Price, who is down 35.73% year to date, but they've seen a nice little run up in the last month. They're up 18%. Another one to keep your eye on is Nike, who is down 35.65% year to date, and they've also seen a nice little gain in the last month, up almost 18%. Next up is Taiwan Semiconductor Manufacturing Company, TSM. I know a lot of you guys love this one. This is down nearly 37% year to date, and they've seen quite the rebound in the last 30 days where they're up 33.5%. And then Stag, guys, I think Stag is looking great. They're down 30.3% year to date, and they are up about 13% just in the last month. And then the second to last stock, guys, is Medtronic, who is down about 25.5% year to date. And I know my boy Ari Gutman is a big fan of this one. I know Russ just put out a video mentioning MDT, so definitely check those out. And then last but not least, guys, I know some of you guys aren't a big fan of this one, but Intel, I definitely think it's one to keep your eye on. They're down 45% year to date, and it's going to be interesting to see how the next couple of years play out for this stock. And I've actually been buying more Intel for my own portfolio lately, and in this next video, I tell you all about it and why I think right now is a pretty good time to pick up this beaten down dividend stock. So check it out right here, and I'll see you in the next one.